So this is about really a gorging of central banks who are politically worried about their exposure to the United States. Is that ultimately what's driving the real alpha in gold this past couple of months? Good morning.
Good morning. Absolutely. When we look at Q1 buying of physical gold, it was led by China, who bought $2.5 billion worth. It was led by Turkey, that bought $2.5 billion worth. We saw additional buying from India, Kazakhstan. And when we look at this growing influence of this gang of BRICS countries, we expect sharper buying from the likes of Saudi Arabia, UAE, and also Russia when they think about stabilizing their economy while the war rages on in Ukraine.
Is this a form of de-dollarization? I mean, we've heard some sort of saber rally. I mean, obviously, gold is priced pejoratively in dollars, but is this a form of removing and protecting themselves politically, geopolitically, from the US and from their treasury holdings?
And from sanctions against their holdings. As we see now, even the Germans are on board with using the extra interest on the frozen assets taken from Russia to help pay for weapons in Ukraine. I think in addition, when you look at Chinese retail buying, part of that is also about thinking about maybe a devaluation, but the real drive in terms of the bulk of buying are these central banks, and the world is incredibly unsafe and unstable if we compare it to how it looked 25 years ago. So every government is looking at this.
So we're looking at a price of gold over the past year up 22%, $2,416 and change. Never forget the 57 cents. But we are running into, I would say, a buffer of where the consumer side, we are seeing a little bit of demand destruction. Is it fair to say that overseas purchases of gold fell by 30% month on month in China? So are we at some kind of a sense of exhaustion point in pricing, or will the central bank buying trump all the retail demand?
The central bank buying will absolutely trump the retail demand. And what we've seen also on the ETFs and on the paper market is there's been exiting on that side. But it's been the physical buying that has been the focus of the central banks. They want to hold it in their vaults.
So let's flick it over to the copper market. Jeff Curry, we know, has been a long evangelist of copper. Copper is the new oil. I mean, I could wax lyrical on behalf of Jeff, but I think we can move on from that. On a slightly more serious note, let's disaggregate this. I mean, we are just exploding on copper. So the first thing I want to understand is, to what extent is that just a blowout on specs relative to the demand structure? And I put that to you because we've seen this in the commodity market last year or 2 years ago when the Russian war on Ukraine began, and we saw this violent constriction and trading by hedge funds in electricity and in the commodity markets at that point. So explain to me what's happening in the copper market.
Yeah, so when we look at that medium-term picture, energy transition, population growth, movement of cities from the G7 with the largest populations and industrial demanding, electricity demanding to the emerging markets, that's the long-term copper story. What has really been a catalyst right now when we think about versus 2020, 2022, has been this realization that AI requires a ton of energy, and to build out that energy supply, we need copper. And most importantly, we need the grids. And so that has been the catalyst in the short term to make things pop. However, when we look at the shape of the curve, we're still in contango in the front, right? And it's really in December where we hit that backwardation. So that is where the market thinks in December we'll have that real supply spike. But when we look at what happened in the cocoa market, for example, that took 3 years to build up that trade. Now copper is having this side where we have this demand catalyst, but the main problem is the supply, because we don't have a shale solution. So when you say copper is the new oil, it is like oil was in 2007, 2008, because we didn't have shale back then, right? You needed this long-term supply to actually cover that demand. So when we look at prices now in copper, in order to get us to a point where the market can rebalance, we will have to hit a demand destruction number. So that is much, much higher than I think what the market is perceiving right now. So 15,000 could very easily be hit quickly, as we saw with algorithmic trading, when we see CTAs, what happened with Nvidia. We could have that exact same thing happen in copper, and there's no stopping them once that momentum is going until we hit a demand-destructive number.
So that is a lumpy call, $15,000. We're at 10,869 and change at the moment. So what proportion of that is just pure spec, and what proportion of that is betting on AI, the greenification, the military use, the AI? Is it those solid pillars of demand that can propel me to 15,000, or is it just short-term vol and financial manipulation?
When we look at the energy transition and that changeover, it is happening, right? We've seen China spend over $500 billion last year just on upgrading their grid system. They're going to do similarly this year. We have seen them be the #1 investor in renewable energy. That is something that is going to spread to other parts of the world, especially when natural gas isn't as easily available as cheaply. Of course, that is also going to be growing very quickly on the LNG side. But we also will have this renewable side driving it. When we look at the grid system in Europe, for example, 40% of the grid system is more than 40 years old. That requires a ton of copper. And another thing I would just add, last year, a lot of the market was already waiting for copper to move, but the market has been so stuck in this negative spiral about the housing market in China that they don't dare get into the copper market. So we're still shrugging off bad news on that residential side and on property. Before
so do you say
really
real money is underweight? If the specs are in and the specs are long and they have that relief through to December, very quickly here, would you say then that real money, there's still room to grow in terms of positioning? Briefly.
Absolutely, yes. Right now it's paper-led, but the physical market and real money is still going to come, and it's going to come over the next 12 to 18 months in a very big way.